All right, so we are looking at the lesson for today. I mentioned last week I would give you 5 examples of visualization of a trade framework. All right, so let's assume for a moment that you have a market that you've deemed bullish. Okay, now this could be in the form of a market that has rallied already, and this has just been a retracement, and it came back down to something that was bullish down here. Maybe this is an optimal trade entry. Maybe this is an order block that it traded off of, and you're expecting to go higher and come back up into this area right here. It matters not that this high gets taken out. We're looking for this in here to be retraded to. Okay. Now here's the key takeaway. If you remember in the mentorship, I talked about inside days. Now, if you don't know what an inside day is, it's a daily range or daily candle that has a lower high than the previous day's high and a higher low than the previous day's low. So that's why it's called an inside day, because the range is smaller than the previous day. So it's inside of the previous day's range. When it creates these types of days, that tends to be bullish. Now, it could be bullish the very next day immediately, or if it doesn't create a run there, going higher, if you're bullish, then it'll be the following day. So whenever an inside day forms, highest probability is the next day. But if it doesn't move, I give it the very next day. And if it doesn't do then, any rallying, then I leave it alone because it's probably consolidating. So what I just gave you there is a real dandy. So have that in your notes. Now, inside days are not essentially bullish by default. They are just precursors to range expansion. So that's why I'm painting this with the expectation that it is bullish. Every example I show you this week will be buy examples or bullish examples, so that we can reverse everything and the logic would be just the same, just reversed for shorts. Okay. So again, this could be a market that has been going higher, created a short-term high, retraced down into some kind of a bullish scenario that now you're anticipating continuation. But now we have something like this. We have an inside day, and we're part of a bullish order flow. We traded back into a order block, this down close candle, and it's an inside day. So you have multiple factors here, and you'd be expecting price to initially run above the previous day's high prior to the inside day. So you're not trading on the inside day. The assumption is once you have this daily candle close, the very next trading day, okay? For instance, let's just say this is Monday. So the next day would be Tuesday. You're trading or looking for what I'm explaining here on Tuesday. If it doesn't form on Tuesday, then we would expect it on Wednesday, okay? It's not limited to form inside days on Monday or Tuesday or Wednesday. Inside days can form any day of the week. But with the logic, the things I teach you with the weekly range and bias and draw and liquidity, I'm trying to give you a framework where these types of scenarios can form in any asset class, and how you can look to see how your tools and concepts blend together to give you a framework for a potential hypothetical trade. All right, so the draw on liquidity is here. So we're looking for that daily fair value gap. Initial draw is the discount low, which would be this candle's high, premium high here, and then consequent encroachment would be midpoint. How we trade above the previous day's high, previous day prior to the inside day, that's first target. So that would be your first scaling. You don't want to take it out above the inside day because it's probably going to be too small of a range. So you're going to use previous day's high prior to the inside day. That will be your first partial. Then, if you wanted, you could use this short-term high if you wanted, but I wouldn't do that because you're already taking it here as a partial. And then you want to see it expand above here and spread, looking for the discount low of the fair value gap here. So if that assumption is understood and we're trying to visualize what a framework would look like on intraday, we're going to assume that this is a 15-minute time frame. And the inside day, high and low, we're going to assume that this is the high of this daily candle. That's the inside day. That's the high of it. And the low, say it forms at the turn of midnight. Okay, so I'm giving you something really, really complicated in terms of not looking for a little reversal here. It's going right down to midnight, and then it turns at midnight. It can happen. It doesn't have to be this format here. It could create a low and then trade a little bit higher prior to midnight and then create that short-term lower low on the previous day, inside day, and then the next day, which would be like a Tuesday, it could be creating a higher low than the day's low on this candle here. Okay, don't lock this logic into it can only form like this. But I'm just giving you this because this is not as likely to form, but I want to include it to get you thinking that don't be afraid of these types of moves that turn right at midnight. Okay, so that creates the low of the day on both days. This candle here and then the next candle that forms. But the logic is we're bullish. We're expecting it to expand higher, and we're looking for it to draw up into this area here. That's our higher time frame bias. That's our draw on liquidity. So what we're looking for is during the 2 o'clock to 5 o'clock in the morning, New York time, that's the London Open Kill Zone, we want to see a low form and then start to rally. Once it starts to rally, we wait for New York. So 7 o'clock in the morning to 10 o'clock in the morning, we'll be looking for the kill zone to give us a retracement in the form of a optimal trade entry. Now, ideally, we want to see a fair value gap from this low to the high prior to 7 o'clock in the morning. Then we start to retrace down in post 7 o'clock in the morning, creating a optimal trade entry, preferably a fair value gap in here. That would be a really nice addition to it to add more, I guess, conviction, more trust behind it. The more PD arrays you have behind it, obviously, the better. But you don't need every single one of them to make the trade viable. So we have optimal trade entry here at New York, 7 o'clock to, say, 10 o'clock in the morning. It could simply be the 8:30 in the morning to 11 o'clock window. So if you're trading those 2.5 hours a day, that could be it as well, because the 8:30 news embargo lifts. So that could be the factor that you're basing this on for the time element. Okay, so we have optimal trade entry, preferably with a fair value gap. It doesn't have to have it, but preferably it should have it. So optimal trade entry there. And then what we're doing is we're taking the fib from the low formed in London to the high prior to 7 o'clock in the morning, wherever the highest high would be, and then the retracement down in after 7 a.m. Or if you're using 8:30 in the morning, whatever the high is prior to 8:30, that's where you're drawing your fib on, and then wait for it to drop down into 62%. And then if that occurs and you have a fair value gap, you can look for that with an order block to take a demo trade long and look for it to break above the inside day high, which is here. And you want to see expansion, like you want to see a lot of aggressive expansion and run through previous day's high here. That would be this level here, hypothetically, on a 15-minute time frame. So it's rallying in here to a time target of, again, 10 o'clock in the morning to noon. That's like London close. And we're looking for that time window to match the draw on liquidity on the higher time frame. So we're looking for that high to be broken out, yes, but we're submitting to this logic here that it's going to trade up to that. Okay, so we're submitting to a higher time frame bullish order flow and allowing time to overlap with that. So 10 o'clock to noon and this logic over here. So let's talk about narrative and how this might pan out, what creates these types of events. If we have this type of framework here, this could be seen with a high impact news event that comes out in, let's say, the 10 o'clock hour. Okay, or it's a 10:30 news driver that comes out. Say this is Canadian dollar or crude oil, and the crude oil inventories come out. They usually come out around 10:30 in the morning, New York time. If that happens, we could see that create the catalyst that would draw a price above the inside day high and then the previous day's high. And why I'm showing these levels, because you want to see expansion with a lot of speed, a lot of distance covered quickly, because that would be the signature that, yes, you broke above the inside day. It's a valid run. You took out the previous day's high here. Now it should really run aggressively to get into this imbalance in here. Okay, and first target or partial would be the previous day's high here prior to the inside day, which would be this level here on the lower time frame. You'd have it noted on your lower time frame charts. And then the discount low, the fair value gap on the daily chart here. That would be here, hypothetically. Okay, and this is not the scale. I'm just showing you with the time element, you're waiting for this, for the price, but time-wise, you're not going to look for a reversal You're not going to be scared that it's reversing because it went above previous day's high. You're not looking at it as like a turtle soup reversal. You're looking for it to go up into this level, which is here. From a time-based perspective, you're looking for 10 o'clock to noon. So you're holding on to as much as noon. But the price element, what's the price you're looking to trade to? The discount low here. So that'll be scaling out at second partial, okay, or second target. Third would be consequent encroachment. Best case scenario would be premium high here. So the trade framework is looking for an optimal trade entry. Now, in this run here, you may not see a fair value gap or a short-term optimal trade entry that lines up with the 62% retracement level. What I would do is, this is the logic on a 15-minute time frame. I would look at a 5-minute chart, scale down to 5 minutes, and you're probably going to see a swing low form between this low and this high prior to the New York kill zone or the New York 8:30 to 11 time window if you're going to use that 2.5 hour window. And I'm providing you flexibility because I don't want to press you into a mold. I want you to think about how it would fit your schedule, your life. Some of you probably can't do 7 o'clock in the morning, but 8:30 is a little bit more appropriate for you. I can't imagine the things that would become catalysts for that to occur, but I'm trying to think outside the box to provide a way for you all to find your own niche in this. But the elements of time, they have to be considered at least in one of those formats. But holding for the expansion up into 10 o'clock to noon, that is kind of like a static. That has to happen. So that way you're allowing the market to expand and the algorithm reaching up into the time elements that it operates on. So if you can get long in here on a 5-minute chart, optimal trade entry, you might see a swing low from this low to the high. It may be inside this part of the run here on a 15-minute time frame, but zooming in on a 5-minute, you'll see another short-term low, which would look like kind of like this, but just beginning with another short-term low here to this high, and then it retraces down into a 62% or 79% retracement level for a 5-minute optimal trade entry. And it might have your 5-minute fair value gap in that time frame, and that would be nice because it would be the pattern you're looking for, the time of day you're looking for it, and you're expecting that expansion on the day after the inside day forms, and then seeing all the targets here. So again, the only thing that's lacking here is the money management. I don't know how much you're going to risk, and again, it's something I would like to see form on a Monday, Tuesday, or Wednesday, but it can form any day, and it could be forming on the basis of a large high impact or medium impact news driver on the economic calendar that would send it careening to this level here on a news report that would probably come out, after 8:30 at least. So 8:30 when that news embargo lifts, between that and say 10:30, okay, some kind of news driver would come out in those 2 hours. That would probably be the catalyst or smokescreen that the central bank uses. And it might be a manual intervention, or it could simply just be the algorithm expanding, using it to have the volatility behind it. But that type of run here would be expected. Once the high's broken here and we get above the previous day's high, it should be really big expansion to get up into that daily fair value gap.